Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to take a look at 3 travel companies that Morningstar believes are undervalued at their current prices. Morningstar is one of the most respected organizations in the financial world for company valuations. And they're predicting that going forward, travel stocks will see a continuous rally as more pandemic restrictions are lifted. So we can see that this article lists 10 different travel companies, but what I have done is go through the entire list and choose to what I believe to be the top 3 companies to discuss in this video, and we're going to take a look at their current financial position and the future expected growth over the next few years. And one thing I want to make very clear at the beginning of the video is that even though these companies are estimated to be undervalued right now, there is still a lot of risk when buying into travel plays. No one knows exactly what's going to happen with the travel industry. We don't know if and when it's going to fully reopen back to pre-pandemic levels. And going forward, there's still a lot of associated risks when buying into these travel companies. And now, before we jump into stock number 1, I'm going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and of course today, we're going to focus on 3 cheap or undervalued travel plays according to Morningstar. And the first company we're going to go over is ticker LUV, which is Southwest Airlines. The company currently trades for $52 per share and is up by 55% on the 1-year chart. And we can see the company is on a slight downtrend as of late. From a high point of over $60 per share, they have now fallen back down to the $52 level. They have a market cap just over $30 billion. And if we take a look at the Morningstar report, the company right now is considered to be undervalued by around 10%. The estimated fair value per share sits above $57. So right now you can buy into the leader of the domestic airlines for a 10% discount. And if we jump over to the actual article, they believe that going forward, international travel will be lagging, and they expect domestic travel to actually expand rapidly through the second half of 2021. So we can see that right now, given all US airlines are pretty much down in the red, they actually expect that LUV or Southwest will perform very well because it's nearly focused on entirely domestic travel, which is unique compared to the other big airlines many people discuss. So right away, LUV is the first travel company to take a look at for your portfolio. Morningstar believes they're 10% undervalued right now, and this company, of course, is one of the main players in the domestic airline industry. So although international travel may not be coming back as fast as domestic, you can go all around the United States using Southwest flights. And if we take a look at their income statement, before the pandemic happened, they were doing a great job of growing their total top line year after year. We can see $20.2 billion of total revenue back in 2016, up to 21.1, 21.9, then over 22. Then, of course, 2020 happened. Travel was essentially shut down completely, and the company dropped from $22.4 billion of total revenue down to only over $9 billion. And then, of course, over the trailing 12 months, it is still down even further to around $6.8 billion. So the company still is very low compared to pre-pandemic levels, sitting around 25% of that capacity. But going forward, travel is beginning to reopen, and many investors believe that domestic travel is going to be very popular and actually outweigh international over the next few years due to risk of different border closures and, of course, future pandemic restrictions if it does get worse. And if we take a look at some analyst forecasts, they're expecting revenue next year for ticker LUV. Southwest Airlines, they're forecasting revenue growth of 70%, up to $15.39 billion, then followed by another 38% in 2022 to around $21.24 billion. They're expecting that by year-end 2022, over $21 billion of total revenue, bringing them back to pretty much pre-pandemic levels. So over the next 2 years, they're forecasting this company will come back stronger than ever and continue to reach pre-pandemic levels, which is a good sign. And we can see right now, the stock is considered a buy coming in at a 2. The $51 share price is very far below the 12-month expectation, right around $70 per share. So overall, the company does have a lot of implied upside over the shorter term to get to the average analyst price target. So Southwest Airlines, ticker LUV, was the first company that I chose to be undervalued from Morningstar's list. Definitely an airline company to take a look at, but remember, there's still a lot of associated risk with the airline companies right now because they are burning through a ton of cash month after month, but definitely a name to take a look at. So this was stock number 1 in today's video, and now if we move on into stock number 2, it is ticker MBUU, which is Malibu Boats. They currently trade for around $69 per share and are up by 33% on the 1-year chart. And this is a smaller company with a current market cap only at $1.5 billion and a very reasonable forward PE ratio of only 11.9. And of course, I understand Malibu Boats is not a traditional travel company. They're not an airline or hotel, but they're still tailored toward the travel industry. And within 2020, many individuals were looking for new activities they can do from home within the United States, and boats were very popular. And many companies in this industry have a massive backlog that will take years to fulfill. And if we take a look at the Morningstar report, they believe the estimated fair value per share for this company sits at around $76, meaning at their current level, they are considered to be around 10% undervalued. So this company, who has a major pipeline of different boating products, who are in great demand right now, is still trading at an undervalued level. And if we take a look at the Malibu Boats article, we can see right now that they're expecting, with consumers not spending as much money throughout the pandemic, consumer saving is at record highs, many individuals have the funds available to actually make these big purchases of boats that Malibu Boats provides. So they expect this company to do well going forward over the next few years, and many individuals are still scared to go international traveling, so domestic activities are going to be the go-to. And we can see over the past quarter, they set record results. All-time highs for a Q3 in terms of earnings per share, and we can see that grew from $1.13 back in 2020 up to $1.82 over the past quarter, and net sales were up close to 50%, which is absolutely insane. And if we take a look at the company's income statement, they were barely impacted by the pandemic. We can see back in 2016 total revenue of $253 million, and that continued to grow year after year after year to around $684 million. Then a slight pullback in 2020 to 653, but now over the trailing 12 months, record highs in terms of total revenue to $768 million, which is absolutely fantastic. So this company is actually benefiting from the pandemic, domestic activities are in demand, and Malibu Boats is definitely a company to take a look at. And if we go over the analyst future projections, total revenues projected to grow in 2021 by 38% to over $900 million. Then next year, they're forecasting another 21% expansion to over $1.1 billion. So the company's projected to continue to expand this top line over the next 2 years in the high double digits. And taking a look, they are considered a buy or a light strong buy, and the $69 share price is very far below the 12-month expectation at over $94 per share. $94 per share expectation over the next 12 months is absolutely massive, and a lot of potential upside for this company going forward. And Malibu Boats is definitely a brand to take a look at within the travel sector that's considered to be undervalued according to Morningstar at this current share price. So overall, this was the second stock we're going to go over in this episode. And now if we continue on into stock number 3, it is ticker EXPE, which is Expedia. They currently trade for $165 per share and have seen a major increase over the past year, growing by over 91%, and they have a market cap at $24 billion. And if we take a look at Expedia, they're a company that allows you to plan your trips. From everything due to planning, actually booking it, and actually getting your confirmation and going through with it, everything can be done on Expedia. It's pretty much a one-stop shop for all your travel needs. And if we take a look right now, the company is expected to be right around their estimated fair value at $156. So the company is not considered exactly undervalued right now, but trading within a few dollars of the estimated fair value at this current level, which is still a strong sign. For a company projected to grow very well long into the future, buying in at a fair price still may be an excellent time to add the company. And if we take a look at their income statement, year over year before the pandemic, they were growing at a fast rate as well. $8.7 billion in total revenue, all the way up to over $12 year-end 2019. Then, of course, once again, like all the others in 2020, major pullback in total revenue to around $5.2 billion, and it continued to fall over the past 12 months, down to around $4.2 billion, or about a third of where they've been over the past few years. And overall, going forward, if we take a look at the analyst forecast, they're expecting a 58% expansion throughout 2021, bringing them back up to around $8.25 billion of total revenue. Then next year, another 38% growth to around $11.4 billion in total revenue, bringing them back to where they were only a few years ago. So Expedia is expected to come back very soon. They're expecting the revenue to recover rapidly, and we can see right now the stock is considered a light buy, coming in at a 2.4. The $161 share price is still below the 12-month expectation at $192. So overall, the company does have some more upside according to the analysts and is trading right around the estimated fair value according to Morningstar right now. So overall, this is the third and final company we're going to take a look at in this episode, another main player in the travel industry. We went over Southwest Airlines, Malibu Boats, and now finally Expedia. 3 companies all doing very well in the travel industry. And now as I wrap up the video, I want to thank you for watching all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in tomorrow's episode.